Gold has just ripped past historic milestones, but is it a runaway rally, or are we standing on the edge of something even bigger? In this full update, I'll take you through exactly what's happening in the gold market today, what the experts are predicting, the risks that could derail momentum, and the critical price levels to watch when the US markets open. As of late September 2025, gold is trading near all-time highs, comfortably above $3,700 per ounce. This surge is not random. It's the result of powerful global forces converging. One of the biggest drivers is the expectation of further interest rate cuts from the U.S. Federal Reserve. Lower rates reduce the opportunity cost of holding gold, since the metal itself does not yield interest. With investors expecting more easing, the incentive to park funds in safe haven assets like gold only grows stronger. The US dollar has also been softening. A weaker dollar makes gold cheaper for buyers worldwide, fueling demand. And this is reinforced by record levels of central bank accumulation. Nations are diversifying away from the dollar by stocking up on gold, seeing it as a hedge against global financial uncertainty. Geopolitical tensions and fears of slower global growth are also adding fuel to the rally. In uncertain times, investors seek safety, and gold has always been a trusted haven. Earlier this week, gold briefly pulled back to around 36.28 before bouncing higher. That dip and resume pattern is classic behavior in strong bullish trends, suggesting buyers are stepping in quickly whenever prices soften. Now, let's hear from the experts. Deutsche Bank recently raised its forecast, projecting an average of $4,000 per ounce in 2026. Some analysts are even bolder, suggesting gold could break the $4,000 barrier before the end of this year if momentum continues. UBS has lifted its target to around 3,800 by the end of 2025, and Goldman Sachs has also grown more optimistic. Technical analysts highlight that as long as gold stays above $3,660, the short-term bullish acceleration remains intact. But with all this optimism, there are caution flags waving too. Technical charts show signs of overbought conditions. Momentum indicators are stretched, and this sometimes precedes corrections. A sudden rebound in the US dollar could hit gold hard. If U.S. inflation data comes in stronger than expected, the Fed could delay cuts or even tighten, which would weigh on the metal. Some analysts draw comparisons with the 2011 peak, warning that even the strongest rallies eventually run out of steam. So, what should you watch when the U.S. markets open? On the bullish side, continued weakness in the dollar, dovish comments from Fed officials, or strong institutional inflows could push gold higher. On the bearish side, a dollar rebound, hotter than expected inflation or jobs data, or profit-taking from traders could spark a correction. The key technical levels matter. Immediate support sits near $3,660. Resistance is in the $3,750 to $3,775 zone. If gold holds above support and breaks resistance, bulls may set their sights higher. But if support gives way, we could see moves toward $3,620 or even $3,560. Stepping back to the bigger picture, 2025 has been an extraordinary year for gold. The metal is up more than 35% year-to-date, making it one of the top-performing assets globally. Central banks are buying aggressively, institutions are revising forecasts higher, and gold's role as a hedge against inflation, systemic risk, and geopolitical turmoil is proving stronger than ever. The World Gold Council's mid-year outlook noted that while gold could continue higher, gains may slow. In stable conditions, they expect sideways moves or modest 0 to 5% growth. In high-stress scenarios, gold could still rally another 10 to 15%. But if tensions ease, the metal could retrace by 12 to 17%. JP Morgan Research expects an average of $3,675 per ounce in the fourth quarter of 2025, with the possibility of hitting $4,000 in 2026. UBS sees 3,800 by end of year and 3,900 by mid-2026. Investing Haven also projects $4,000, pointing to continued central bank demand and looser monetary policy. The message from all of this analysis is clear. Gold's structural support remains intact. Central banks continue buying, investors still see it as a hedge. Macro uncertainty is not going away, but that doesn't mean the price will rise in a straight line. Short-term corrections are part of the game, especially when technical indicators are overheated. So as we look ahead, here's the roadmap. If momentum and macro drivers hold steady, gold could push into the $3,800 to $4,000 range. If sentiment cools or data shifts, we could see pullbacks. The early hours of the U.S. market session will likely set the tone. And over the long term, the structural drivers supporting gold appear durable. Gold has always been a reflection of global trust, fear, and uncertainty. Right now, it's telling us that the world remains uneasy and that investors are preparing for storms ahead. This was your Deep Dive Gold Market Update for September 2025. Disclaimer: this video is for information, education, and discussion only. It is not financial advice. Do your own research, consult licensed financial professionals, and make independent decisions before investing or trading.